Could QUBIC be one of those cryptocurrencies that looks massively undervalued after a painful decline? Or is the market already warning investors that the hype has moved faster than the fundamentals? QUBIC has a fascinating story because it is not trying to be just another blockchain. It combines smart contracts, high-speed transactions, AI computation, and a proof of useful work model where mining is designed to contribute computing power toward artificial intelligence rather than simply solving meaningless cryptographic puzzles. But despite that ambitious technology, QUBIC remains a relatively small cryptocurrency, ranked around the number 284 area, and that creates one huge question. Is the market overlooking QUBIC, or is there a reason it hasn't received a much higher valuation yet? QUBIC is an independent blockchain ecosystem built around QUBIC, its native token. The project describes QUBIC as an energy unit used to execute smart contracts and access network services. Instead of traditional transaction fees being paid to validators, QUBIC used for certain network operations is burned. Standard transfers are also designed to be feeless. The most unusual part of QUBIC is its proof of useful work system. The network uses computational work to help train AI through its iGarth initiative. In other words, QUBIC is trying to connect blockchain security and cryptocurrency mining with useful artificial intelligence computation. That is a very different proposition from the typical layer 1 narrative. And QUBIC is not presenting this purely as a future idea. The project says its network is already live, with AI computation, smart contracts, Oracle functionality, and extremely high throughput. If you're enjoying this kind of deep crypto analysis, make sure you like the video, subscribe to the channel, and compulsory leave a comment below. I want to know what you think. Is QUBIC an undervalued AI and blockchain project, or is the market correctly pricing in the risks? Now let's talk about the price. This is where the bullish argument becomes much more complicated. QUBIC trades at a tiny fraction of a dollar, which can make the token look incredibly cheap to retail investors. But remember, token price alone tells us almost nothing about whether an asset is undervalued. QUBIC has an enormous token supply compared with many other cryptocurrencies. Its maximum supply has been reduced from 1 quadrillion tokens to 200 trillion following a community vote, while the network uses emissions and multiple burn mechanisms to manage supply. That means investors need to think in terms of market capitalization and future supply rather than simply asking how many zeros are in the token price. And this is exactly where QUBIC becomes interesting. The network currently operates with a weekly emission structure, but a significant portion of those emissions is burned. QUBIC's tokenomics are designed around gradually reducing net emissions through scheduled halvings and increasing burn mechanisms. The next major event is particularly important. QUBIC's second halving is scheduled for Epoch 227, beginning around August 19, 2026. The project says this halving will further increase the percentage of weekly emissions that are burned, reducing net supply growth. That could become an important catalyst for QUBIC, but there is a catch. A reduction in supply does not automatically create higher prices. For a halving to matter economically, demand needs to remain strong or increase. If demand remains weak, a smaller supply increase may not be enough to create a sustained price recovery. So the real question is whether QUBIC can grow network usage at the same time that its tokenomics become more restrictive. Technically, that is what traders should be watching. Instead of focusing only on one exact support or resistance number, the bigger signal is whether QUBIC can establish a series of higher lows and eventually break through previous swing highs with expanding volume. If buyers repeatedly defend the recent lows, momentum could begin improving. But if every rally gets sold quickly, that would suggest that the market is still treating QUBIC as a speculative trading asset rather than a long-term accumulation opportunity. And this is where the current structure becomes important. QUBIC has experienced major volatility throughout its history. The token has previously gone through dramatic rallies followed by deep corrections, which means traders need to be careful about assuming that one strong green candle represents a permanent trend reversal. A breakout without volume can fail. A breakout followed by a quick rejection can become a bull trap. And a rally driven mainly by social media excitement can disappear just as quickly as it started. That is why momentum confirmation matters. Now let's talk about ratings and signals. There is no traditional Wall Street analyst consensus for QUBIC. You won't find a reliable institutional panel saying QUBIC is a buy, hold, or strong sell in the same way you might see with a publicly traded company. Instead, the signals come from the network itself: market structure, adoption, tokenomics, development activity, liquidity, and investor sentiment. And those signals are mixed. The positive signal is the technology. QUBIC claims extremely high throughput, with its network reporting more than 15 million transactions per second in verified testing. It also operates a feeless transaction model and combines blockchain infrastructure with AI computation. The project is also continuing to develop its AI infrastructure through iGarth. Those are legitimate differentiators. But the negative signal is that ambitious technology does not automatically translate into token value. This is one of the most important lessons in crypto. A project can have impressive technology and still have a token that underperforms. Why? Because the market eventually asks one question: does anyone actually need the token? For QUBIC, the answer needs to come from network usage. If smart contracts increase, AI computation grows, Oracle usage expands, developers build applications, and more users interact with the ecosystem, then QUBIC's utility becomes much more compelling. But if the technology remains impressive while actual economic activity stays limited, investors could continue assigning the token a relatively low valuation. And that brings us to the undervalued versus trapped debate. The undervalued argument is powerful. QUBIC is attempting to solve several problems at once. It wants blockchain transactions to be extremely fast. It wants transfers to be feeless. It wants mining to perform useful AI computation. It has an on-chain Oracle system. It has smart contracts. And it has a tokenomics system designed around burns and declining net emissions. If even a portion of this vision becomes widely adopted, today's valuation could potentially look very small compared with the size of the markets QUBIC is targeting. AI alone is one of the largest technology narratives in the world. Blockchain is another. Decentralized computing is another. QUBIC is attempting to sit at the intersection of all three. That is the bull thesis. But now let's flip the argument. The market has seen countless projects with ambitious technology. Many failed to become meaningful ecosystems. The problem is not whether QUBIC has a unique concept. The problem is whether it can convert that concept into sustained demand. A 15 million transactions per second claim sounds incredible, but throughput is only valuable if users actually need that throughput. AI mining sounds innovative, but AI infrastructure needs to generate useful and competitive outputs. A deflationary tokenomics model sounds attractive, but burns only become powerful when the network generates enough activity to remove meaningful amounts of tokens relative to emissions. So the value trap argument is not necessarily that QUBIC is a bad project. The argument is that the market may be waiting for proof, and that proof needs to come from adoption. There is another major factor to consider: supply. QUBIC's 200 trillion maximum supply sounds enormous compared with coins that have billions or millions of tokens. But comparing token counts between different cryptocurrencies is meaningless. What matters is how the supply interacts with market capitalization, emissions, burns, and demand. QUBIC's burn system is therefore extremely important. The project has already reported tens of trillions of QUBIC burns since launch, and the protocol is designed to continue removing tokens through smart contract execution, IPOs, Q-earn penalties, and scheduled supply management mechanisms. If network activity grows while net emissions continue declining, that combination could become increasingly bullish over the long term. But once again, demand is the key. A shrinking supply curve cannot compensate forever for weak adoption. Now let's talk about the risks. The first risk is competition. QUBIC is not operating in an empty market. It competes with established Layer 1 networks, AI-focused crypto projects, decentralized compute protocols, and other ecosystems chasing developers and users. The second risk is execution. Building a blockchain is one thing. Building an ecosystem that people actually use is much harder. The third risk is volatility. QUBIC remains a relatively small cryptocurrency, and smaller assets can experience extreme price movements when liquidity changes. The fourth risk is tokenomics. Although QUBIC has a maximum supply and burn mechanisms, new tokens are still emitted every epoch. Investors need to watch the relationship between gross emissions, burns, and actual circulating supply, rather than assuming that deflationary automatically means the supply is shrinking every moment. And the fifth risk is the AI narrative itself. AI is one of the hottest sectors in technology, which can be an advantage for QUBIC, but it can also become a problem. When a narrative becomes extremely popular, investors may value projects based on future expectations rather than current economic activity. If expectations get too high, even good projects can suffer major corrections. Now let's look at the bull case. The ideal scenario for QUBIC begins with continued development of iGarth and the proof of useful work ecosystem. AI computation becomes more useful, developers begin deploying more smart contracts, Oracle usage increases, the number of applications grows, network activity expands, and QUBIC's burn mechanisms begin removing supply at a faster pace relative to emissions. Then the second halving arrives and further reduces net emissions. If all of these things happen during a broader crypto bull market, QUBIC could have a powerful combination of fundamental and speculative catalysts. The market could begin viewing QUBIC not as another small altcoin, but as a serious decentralized AI infrastructure project. And if that happens, the revaluation could be significant. But the bear case is equally important. Suppose AI adoption within QUBIC fails to accelerate. Suppose developers choose competing ecosystems. Suppose network usage remains low. Suppose the broader crypto market turns bearish. In that environment, the token's ambitious technology may not be enough to attract sustained buying. And if QUBIC fails to reclaim important technical levels, every rally could continue producing another lower high. That would be a warning that sellers remain in control. The worst case scenario would be a combination of weak adoption and declining liquidity. If fewer users interact with the network and fewer traders want exposure to QUBIC, the token could remain depressed even while the technology continues improving. That is a frustrating reality in crypto. A good project does not automatically equal a good token investment. The market needs to recognize the value. So what should we watch from here? In the short term, watch the chart. Watch whether QUBIC establishes higher lows. Watch whether breakouts come with real volume. Watch whether resistance becomes support. And watch what happens around the upcoming second halving. A halving can create attention and speculation, but the real test comes afterward. Does demand increase? Does network usage grow? Does the token maintain its strength once the event is no longer a headline? Those are much more important questions. In the long term, QUBIC has one of the more unusual narratives in the cryptocurrency market. It is trying to combine blockchain infrastructure with useful computing and decentralized AI. If the project successfully turns that vision into a functioning ecosystem with meaningful demand, the current valuation could eventually look very different. But if adoption fails to keep pace with the ambition, the market may continue treating QUBIC as a speculative altcoin. And that is a central debate. Is QUBIC undervalued because investors are overlooking a genuine decentralized AI infrastructure platform? Or is QUBIC cheap because the market is still waiting for evidence that all of this technology can create sustainable economic value? The bull case says the combination of AI, useful proof of work, high throughput, feeless transactions, smart contracts, and increasingly restrictive tokenomics could make QUBIC one of the more interesting smaller cap projects in the market. The bear case says technology alone is not enough. QUBIC needs users, it needs developers, it needs applications, it needs real network activity, and ultimately, it needs the value generated by that activity to create sustainable demand for QUBIC. That is why I would not judge this project simply by its current token price. The more important story is happening underneath the chart. If network adoption accelerates while emissions continue falling, the market could eventually be forced to reconsider QUBIC. But if adoption remains weak, even a sophisticated tokenomics model may not be enough. And that leaves us with one final question. Are we watching a deeply undervalued decentralized AI project before the market fully understands what QUBIC is building? Or are investors once again getting excited about technology before the economic value has actually arrived? The next major trend could answer that question. Will QUBIC use its upcoming supply reduction and growing AI narrative to finally break out of its long-term weakness? Or will sellers prove that the market still isn't convinced? Remember, this is not financial advice. Always do your own research, understand the risks, and never invest money you cannot afford to lose.